The world is currently trying to transition into new financial order when in one hand monetary authorities might attempt to hold interest rates above 0% and on the other hand lessen the economic pain from these higher rates by using quantitative easing, or in simpler terms, money printing, to smooth the effects of these higher rates. This is the main thought contained in this video, and moreover you will learn the real reason why stock markets are still in a rally mode beginning from 2023. For that, let me provide you a bit of essential context. Stock markets broke out of their chains in October 2023 and are rising to new historical highs up until this day in spite of macroeconomic headwinds. The benchmark S&P 500 index stormed through the 5,000 point threshold recently, and since October, the index returned more than 23%. Also, European stock markets performed quite well, given that pan-European stock index Stoxx Europe 600 jumped almost by 16% in the same period. Given the historical average of around 9% return on stocks, this is quite strong performance we have seen in the last 4 months. This development, however, may be surprising given the macroeconomic and geopolitical headwinds, and also given the aggressive monetary tightening by the Fed. Out of norm is also the narrow market breadth, or the fact that virtually all growth is delivered by 7 biggest companies in US markets. But even European stock markets grew in an undiversified manner. We are currently witnessing numerous irregularities, be it in the economy or financial markets, oftentimes lacking historical precedent. Well, what causes all of this? There is a chain of events that led to where we are today. After a huge correction in stocks and bonds during the year of 2022 due to aggressive tightening policy and slowing economic growth, the liquidity situation began to change. The strong sell-off and strict policy led to huge stress that was befalling on financial markets. The first serious sign of that stress was the near collapse of United Kingdom government bonds due to sharp sell-offs towards the end of 2022. The situation was salvated by quantitative easing policy of Bank of England that started buying those government bonds and preventing them from collapsing any further. The reason I'm mentioning this event is because it was the moment where Western world received their first glaring red flag and when the liquidity drain or monetary policy strictness started to take a turn. It is because both monetary and fiscal authorities began to realize that current financial system is not fit for higher interest rates. Simultaneously though, they knew that they cannot lower these rates because that would risk spiking inflation and erasing the achieved progress. That is where a new approach was needed. The new approach was therefore created. On one hand, hold a shield of higher interest rates that will protect you against high inflation, and on the other hand, hold a sword of quantitative tightening that keeps the economy growing and financial systems from withering. The only problem is that this approach is pretty much unprecedented, and therefore the long-lasting consequences are unknown. This new approach therefore assumes above zero interest rates and either or combination of quantitative easing and increased fiscal debt spending, which injects liquidity into the system and protects it from breaking down due to higher rates. Now, many experts expected recession in 2023, which is still being predicted by some of the most precise recession indicators. These include yield curve or leading economic index. However, US recession did not arrive and economic growth surprised to upside throughout the year. Even now recession is in no sight. It is possible that this new approach of higher rates and higher liquidity injections broke the traditional recession indicators and old way of analyzing the economy. Fiscal authorities are nowadays intensely intervening with the financial markets and economy. But I think it's still too early to render those recessionary indicators as invalid, because the cycle is still not done and recession might arrive after all either in this year or the next year. So that is my interpretation of the causes behind current chaos in financial markets and why even the best portfolio managers are very much contradicting each other on what is to come next. Strong government interventions have probably changed the game. And now it seems that it is far more useful to watch changes in liquidity flows than study, say, fundamentals or history. For example, in this regard, cryptocurrencies are very sensitive to changes in liquidity, and therefore they have been pretty accurate proxy to changes in liquidity levels. If you look at these two charts of Bitcoin price and changes in Fed reserves, you will see that they seem pretty similar. Changes in the Fed reserves is one of the many ways to measure liquidity changes in post-COVID America. This chart therefore clearly shows that trend of liquidity drain slowed down with respect to events in United Kingdom after October 2022, but a complete trend reversal did not arrive until the March 2023, when some of the bigger regional banks in United States started collapsing. This was the moment when even US authorities definitively realized that quantitative tightening cannot continue because financial system cannot handle any more of it. In reaction to these March bankruptcies that I believe would otherwise grow into full-blown economic recession in USA and Europe, American Fed printed hundreds of billions of dollars. And United States Treasury spent down significantly their reserves to save the day. Various liquidity programs were created to stave off this banking crisis, and it worked. This sector stabilized, and spillover effect that could have otherwise caused another great financial crisis was contained. Learning from these events, US fiscal and monetary authorities saw that high interest rates create too much stress, and therefore, from March and on, the liquidity levels were steadily increasing up until today. This prevented other crises from surfacing so far and led to falling inflation and above consensus strong economic growth. This environment was and is still very supportive of stocks and to a lesser extent of bonds. Moreover, it led to significant increase in prices of cryptocurrency, which is the most sensitive asset class to changes in liquidity so far. Therefore, from what I laid down in this video, it seems that financial markets are now playing according to new rules, and the older methods of analysis are being pushed aside. This abrupt change of environment naturally causes chaos and skepticism in the minds of investors and analysts. I personally am subjected to this skepticism because these new rules by which the markets are playing, ignoring fundamentals, seems too risky to me. Most importantly, what are the consequences of these policies and interventions? I don't think anybody really knows. How is it possible that inflation is falling towards 2% target in spite of strong economic growth and extremely strong financial markets, which is an economic stimulation in and of itself? Historically, to lower inflation in a sustainable manner, you had to crush the economy into recession and grow unemployment rate. None of this is happening right now. According to official US statistics, the opposite is happening. The economy is sporadically expanding and unemployment sits at historic record lows. It is possible that inflation will experience a resurgence or that it will stay persistently higher above the 2% target because of that. Where is the recession that the economic indicators are predicting? Are those indicators suddenly useless? Certainly a brave statement to make. And the thing is, nobody really have the answer to those questions. This is what causes the chaos and skepticism on the markets. Yes, markets are in fact skeptical. What else would be the reason why only 7 biggest stocks were behind virtually all of the growth of the stock markets in the year 2023 up until now? Institutional investors especially are not willing to risk their capital with smaller and more risky companies, because as you yourself can see, the decline of tens of percent in the stock price is not that unusual in these markets, even though these might be solid, international big companies. Well, that's how I view the financial markets currently. Hopefully this makes sense, and definitely let me know in the comments if you agree or disagree with some of these views. It is a long-term trend, but financial markets are losing their independence and are increasingly being influenced by fiscal and monetary policies. Just listen, for example, to Stan Druckenmiller complaining about using US bond markets in the past to execute on successful trades, but now it is virtually impossible because these are being too manipulated, sending too many false signals.